Hello, my friends. This is Doug Fabian. Welcome to the weekly ETF report. Today is Wednesday, June 10th, 2015. Thank you for joining me today. As always, three things to talk about. I want to begin with China. I have talked ad nauseum about China so far this year, the wonderful exchange traded fund options that are available, and I want to leave you with this news regarding China ETFs. Now, as you know, exchange traded funds are based on indexes. And every June, major indexing companies change the way their indexes are comprised. And one of the big issues in the news right now is how China, and specifically China A shares, are being added to certain indexes. Well, when this takes place, it means that there's going to be a lot of fund managers who are index investing around the world who are going to need to raise their allocations to the new indexing requirements within that particular index itself. And A shares are being added. MSCI, which is one of the largest index providers, has said that they're going to add China A shares to their indexes, not right away, but through the course of the summer, and the Chinese government has to make some changes regarding liquidity and the like. I give you this news as just another positive relative to China ETF investing as we're going through the course of the summer. So I review this as a very bullish thing and a good thing for our holdings in China ETFs. Next, I wanted to talk about the S&P 500. And we've had a lot of sideways action in the S&P 500 over the past 4 months. Here's a chart of SPY. This is the exchange traded fund, the largest exchange traded fund in the world, and it represents the S&P 500. You can see from a price action standpoint that we're basically at the same price point that we were at the end of February of this year. So 4 months has gone by and we've kind of traded sideways in the S&P 500. I'm reading some articles today about how the market's going to, gather its breath and surge higher this summer. I read another article on how the Dow is going to crash 5,000 points in the next 60 days. Always a wide degree of opinions out there. I'll just point out a simple concept on this price chart. If we were to break below 203, which is the current 200-day average of SPY, that would be a negative for the long-term stock market trend. At this particular point in time, stocks are holding their own. Haven't made a lot of money this year, up 2.5% or so year to date on the indexes. But if we break 203, that's going to be a warning sign of a market correction. Lastly, I want to talk about taxes, and I'm going to be talking about taxes quite a bit on my podcast this week. And the issue I wanted to bring up with taxes is this. When it comes to ETF investing, and if you're investing inside of your IRA, you have no taxes. You don't have taxes on dividends, you don't have taxes on interest, you don't have taxes when you buy and sell. The only time you have taxes relative to your IRA accounts is when you withdraw money. Now, if you're under age 59 and a half, you're going to get taxes and penalties. But if you're over age 59 and a half, anything you take out of your IRA is going to be taxed at your ordinary income tax rate. Now, let's talk about your taxable money. Many times people get concerned about taxes. Well, there's really 4 kinds of tax categories you need to be aware of. First of all, there's the category of just interest and non-qualified dividends. They are taxed at ordinary income rates. When it comes to qualified dividends, they're taxed at a maximum rate of 15%. If you hold an ETF for longer than 12 months, it's a long-term capital gain, and that's taxed at 15%. But if you buy and sell an ETF and have a gain and it's less than 12 months, that's ordinary income. You need to know what the tax rules are to effectively manage your portfolios and make sure that you're not paying excessive taxes along the way. So that's it for me this week. Thanks for tuning in. Remember, you can send me your emails, askdoug@dougfabian.com, and thank you for tuning in.